Welcome to my video on notes receivables. This video is my final one for this particular course, so let's finish it up. Regarding notes receivable is not unlike accounts receivable. When you see the term receivable in an account title, it conveys a right to receive money. There are a couple of distinctions between the two assets, though. First, how quickly either one will be collected. AR comes in quicker of the two. Most companies have credit terms of 30 days, maybe 60. Notes receivable takes a little longer, usually at least 3 months. Notes receivable will also involve an interest component. Think of interest as charging a fee for allowing that additional time to pay. The interest will be repaid upon the note's maturity date. Here's an example of a promissory note used when creating a note receivable. Across the top, you see the principal amount along with the date of the note. Right underneath those, we have the duration of the note, 90 days in this case. In other words, this note is due 90 days after June 1st. Towards the middle, we have the holder of the note, or the payer. The holder/payer is the party who will receive the payment upon the maturity date. Underneath the holder, we have the principal amount written out similar to how one would write on a check. Below that, you have the interest being charged on the note. Lastly, we have who will collect the note payment, and in the bottom right corner, the maker of the payee of the note. The maker is the party who will pay the principal plus interest at maturity. When dealing with notes, you'll probably be asked to determine the due date. The following process is very effective. The previous 90-day note was signed on June 1st. June has 30 days in it, so this note will last for the remaining 29 days of the month. We're 29 days into the life of this note. After June comes July. This note will take up the full month of July and its 31 days. Now we're 60 days into the life of the note. After July comes August, which also has 31 days. So the entire month of August adds on 91 days. However, the note was just for 90 days. So we only need 30 days in August to get to the maturity date. Consequently, this note will mature on August 30th. If you're wondering, yes, you probably need to refresh your memory on which months have how many days. There are a few ways you can recall that information. The following technique may be familiar to you already if you remember your nursery school rhymes or are a fan of obscure Batman villains. 30 days hath September, April, June, and November. February has 28 alone. All the rest have 31. The other way is the knuckle technique. If you form your hands into fists and look down at them, Imagine these scribbles to represent their rises and dips. Starting with your left pinky knuckle, those ridges and valleys will correspond with the months of the year. The months on the top knuckles will have 31 days, and those between will have 30 days, with February being the exception of 28 days. Now let's talk about our journal entries, specifically how we put notes receivables on the books. We'll use our previous example of the 90-day $1,000 note at 12%. Typically, they occur in one of two ways. Sometimes, notes receivable occur as a result of a sale. A customer may want to make a credit purchase, but he knows right off the bat that he needs more time than the standard credit allows. So he'll sign a note right then and there. This entry will consist of a debit to notes receivable and a credit to sales. This is just like your standard credit sale, except we swap accounts receivable with notes receivable. Other times, a customer makes a credit purchase, then realizes that he can't pay on time, so he requests to sign a note. Basically, the customer is saying, I can't pay by the due date, let me have some extra time, and I'll pay interest for the accommodation. In this scenario, the original sale was already debited to AR. So we're going to cover that account receivable with a note receivable. Debit notes receivable and credit accounts receivable. We're just moving the $1,000 owed to us from one receivable to another. When the payment date arrives, we have to book one of two entries. Which entry we book depends on whether the customer pays at that time or not. When the customer pays, we say that the note is honored. To record the payment, we'll debit cash for what was received and credit notes receivable off the books. Our credit to notes receivable will be for the same amount we debited to put it on the books. $1,000 from our original entry. That said, the cash collected won't just be the face value of the note. We'll also collect interest, which will be credited to an interest revenue account. This is a revenue because we've earned this money by allowing our customer to take that additional time. How much interest is earned? We have a very simple formula. Interest earned equals the principal amount multiplied by the annual interest rate multiplied by the time period component. The principal amount is the $1,000 for which the note was originally written. The interest rate was 12%. Remember, that 12% is the annual rate, meaning the customer would pay that much over an entire year. But this note was only for 90 days. So we use the time period component to prorate it for that shorter duration. This time period component will be 90 over 360. The 90 days is how much time has passed, i.e. the life of the note, and 360 is how many days are in a year. I'm aware that a year has 365 days, but when calculating interest, most institutions use 360 because it provides cleaner numbers. For that reason, using 360 instead of 365 is sometimes called the banker's rule. In this example, $30 is the interest earned. So the total cash collected will be $1,030. What if the customer doesn't pay on the maturity date? Or to use the terminology, the note is dishonored. This entry will be almost identical to when the customer paid, except our debit goes to accounts receivable. Basically, on the maturity date, we must book an entry. We either record the cash if the customer pays, or we put the principal and interest into accounts receivable. If a note is dishonored, we have a couple of options for how we can deal with it. One option would be to let the customer sign another note. In this case, we would cover that account receivable with a note as we already discussed. In other words, we'll credit that amount out of AR and put it back into notes receivable. Now the previous note's interest revenue has become part of the current note's principal, meaning the customer will pay interest on the interest. Alternatively, if the customer knows that he absolutely cannot pay, we can write off the bad debt as we described in the previous video. Debit allowance for doubtful accounts and credit AR off the books. Know that allowance for doubtful accounts can only be used to write off delinquent AR amounts, not notes. This is why we immediately put the dishonored note into accounts receivable. If we're going to write it off, doing so is easier if it's already in AR. Let's continue with this example. Imagine a customer called a day later and said, "I'm sorry, I promise I can pay, but it's going to take some time. Let me sign a 150-day note and 15% annual interest." If you feel so inclined, pause this video and see if you can figure out the maturity date. Did you get it? The note was signed on September 1st. There are 29 days left in September, so September will put us 29 days into the life of the note. Next comes October, in which there are 31 days, putting us 60 days into the life of the note. Next, November with its 30 days, taking us to 90 days. After November comes December with its 31 days. Now we're at 121 days. Finally, we have January of the following year. We're trying to get to 150 days, so we won't need the entire month of January. Rather, we'll just need 29 days, meaning the due date is January 29th. The fact that this note won't mature until next year adds a little complexity to the entry on that date, but only marginally so. Presuming this company has a calendar fiscal year, on December 31st, it'll need to book an adjusting entry, just as described in video number 5. Interest accrues with the passage of time. meaning we've earned some interest between the inception of this note on September 1st and the year-end reporting date, December 31st. When we've earned money, we credit a revenue account. We've earned this money, but the customer won't pay it until January 29th, meaning we currently have a right to receive it in the near future. So we debit interest receivable. The amount of interest earned can be calculated using that formula. Multiply the $1,030 principal by the 15% annual interest rate by 121 over 360. 121 days have passed between September 1st and December 31st, so that's the numerator in the time period component. Interest earned so far, $51.93. On January 29th, we record the payment. Obviously, debit cash for the amount received and credit notes receivable off the books. Notes receivable will get a credit of the note's principal, $1,030. We're not just collecting the face value of the note though. The $51.93 of revenue that we earned as of December 31st will be paid at this point in time. But we also need to record the revenue earned since then. Use the same formula, but adjust it for the time passed since the last interest accrual. $1,030 times 15% times 29 over 360. Interest earned, $12.45. If you analyze those two time period components, last year we accrued for 121 days, and this year we accrued for 29 days. Combine those two, and we use the entire 150 days of the life of the note to calculate interest. We just split the interest earned between the revenue earned last year and the amount earned this year. Total cash collected will be the sum of the principal plus the interest receivable plus the interest revenue, or $1,094.38. Thank you very much for watching. My college teaches financial accounting over 2 semesters, so this video may only take you to the midpoint of your semester. Depending on when you're watching this, the next video may not be available. If it isn't, please be patient. I hope to have the videos for the final half of financial accounting ready in the near future. All that aside, thank you so much once again.